Welcome, everyone. I'm Erik Schatzker, editor-at-large here at Bloomberg. And as you just heard, the first in our amazing array of speakers is none other than Greg Fleming. He's the CEO of Rockefeller Capital Management. For those of you who are not familiar with Greg's bio, I hope most of you are by now. A few details. Greg has been the CEO of Rockefeller since March of 2018. Previously, he ran Morgan Stanley Wealth Management. And before that, he was president and chief operating officer of Merrill Lynch. Greg also has been a senior research scholar and a visiting lecturer at the Yale Law School, where he earned his Juris Doctorate. Greg, it's great to see you.
Thank you, Erik. Good morning. Hopefully next time in person, huh?
Indeed, indeed. We're all moving back there as fast as we possibly can. Greg, I'd like to begin by giving our audience some context for our conversation. How much in client assets does Rockefeller currently have?
Erik, we're managing about $75 billion in client assets today, which is up quite nicely from when we commenced with Rockefeller Capital Management in March of 2018, where we had about $18 billion in client assets.
I was just about to say, if I'm not mistaken, you're up almost fourfold.
Yes. We're taking this, as you know, wonderful brand, Rockefeller, and we're building it out across the United States in cities with significant amounts of wealth and potential clients.
And what's the median net worth of Rockefeller's clientele?
You know, Erik, we're looking to work with clients that can benefit from our ability to deal with a broad cross-section of needs that they have and complexity. So that could be somebody who has several $1 million and is on their way toward greater wealth, or they might have a family situation where we can advise on generational planning. So, you know, we have clients, from the single millions all the way through to, north of 100 million and up from there. But we're focused on the clients that will benefit from our ability and the ability of the elite advisors that we've put in place to deal with the complex set of financial needs.
If I'm not mistaken, your business is mainly managing your clients' investments, but there are also a number of other advisory services you provide, tax, for example, estate planning, governance, even investment banking. I think I've got those right. Tell me if I do, and also add anything I've missed.
You do have them right, Erik, by and large. So we've got wealth management really as the core of Rockefeller Capital Management. And our focus on wealth management is working with individuals and families that are high net worth and ultra high net worth, and typically have a broader and more complicated financial situation for us to help with. We deliver the services that you described, Erik, through these elite financial advisors who are used to dealing with clients that have that complex set of needs. So we start with investments and asset allocation, but we add in the family office services you talked about, wealth planning, different wealth planning strategies, bill pay, taxes. We own 2 trust companies, so we do a tremendous amount of generational work, and actually have with the Rockefeller family. They're in their 7th generation, and we and the predecessor company have been working with them for a long time. We also build in the strategic advisory capability that you mentioned. Rockefeller Strategic Advisory, which is a boutique investment bank. Many families, in particular in the United States, as you know, Erik, generate their wealth through building a business, a private business, and we can provide them advice on that through Rockefeller Strategic Advisory. And then lastly, we have an asset management business, Rockefeller Asset Management, and that business is really built around ESG. The Rockefeller family was one of the pioneers in sustainable investing. In fact, coined the phrase impact investing way back in 2007 at the Rockefeller Foundation. And because of that, we've got long track records and real expertise in our asset management business in the ESG space. So those products we make available to our wealth management clients as well.
Greg, there's no question wealthy Americans are in the crosshairs of President Biden's tax proposals. How would his plans affect your clients?
Well, look, everybody's looking very closely at this. The one thing I'd say up front, Erik, and you know this, you report on this all the time. Right now, what we have in terms of potential changes is the president's speech last week, and then they're out, he and the administration are out talking about it. There's no bill yet. There's nothing concrete. There's different notions out there, maybe a fact sheet, but there's a lot to come in terms of what will actually become a change in law in the United States. And there's a negotiation that's going to take place, obviously with the Republicans in the Senate, but there's some swing Democrats, Joe Manchin in West Virginia being at the front of the line there. They're going to have a lot to say on what actually happens here. So our clients are clearly focused, and there are potential changes in tax law, including in estate changes that could impact the ability to pass assets and businesses to the next generation with the step up in basis. So there's a lot there, but we're counseling our clients, be patient. Let's survey the landscape here and make sure we know what's happening before we jump in any one direction. And there's a lot of wood to chop before we get to a bill that will get through both houses of Congress and be signed by the president.
Leads me to a number of follow-up questions, but I'll begin with this. What of Biden's tax efforts, Greg, do you expect will survive the congressional sausage making?
That's a great question, Eric. I think I would start with the corporate tax increase. I think it came down recently, as you know, under President Trump. And I think given the magnitude of the spending plans that the president has outlined, they're going to need revenue. And if you take the corporate tax from 21 to 28%, it's about $1 trillion over the time frame that the president's looking at. So it's hard for me to see that they don't try to go after that, given the need for revenue and the number of, the few number of places you can really get it. So that one looks to me like a bit of a honeypot alongside the spending priorities that the president put out.
You mentioned step up in basis. The president is clearly intent, Greg, with that proposal and others on disrupting what I might describe as the intergenerational transfer of wealth. Doesn't that put a target very clearly on the families you serve?
Well, the one thing, Eric, in terms of that step up in basis that's not clear, and there was some discussion around this even after the president's speech, and the early discussion around what might come out here. They don't want to prevent, I think, the step up in basis necessarily for family businesses, because that might force a family business that's been within the family for literally generations to be sold. So I do think they're going to look very carefully at how to try to carve that out, even if they move forward on a broader effort to eliminate the step up on financial assets. So there's just so much that needs to be worked through here. But I don't think either party or the president is trying to say to a family that might have been building a business for literally decades, if not longer, that the death of the first or second generation founder or founders is going to require the family to go out and sell the business in order to pay the tax that's due at that death. So that's one example of work that needs to be done as they actually start to move forward here, because I think the intent isn't to go after that.
What about the underlying principle? In your view, is it right? Is it fair for the administration, for this president, to target multi-generational family wealth?
Well, Eric, there's been a tug of war here in terms of the assets that you can provide, that at death that you can give to the next generation through the exclusion. So, again, under President Trump, the assets that could be excluded, the dollar amount went up, and that's gone up and down over decades through different administrations, Democrats and Republicans. So there's always a discussion around in the United States the ability to create wealth and keep it on a more long-term, and sometimes you hear the word dynastic as a pejorative term basis. There's some part of the American dialogue that doesn't like that as much. So it's often brought into the picture. The reality, though, is that for people who marshal enough assets to be able to leave them, across generations, those assets have already in every single situation been taxed somewhere else. So if you have financial assets that have come through a corporation, the corporation has paid taxes on those. So, there are good, equitable arguments on both sides. And frankly, the American people, through their representatives, continue to debate this over the decades. The fairness issues around, well, the tax has already been paid in one way or another, and then those who say, well, wait a minute, each generation should really have to start, more from scratch in dealing with the world around us. So I think, Eric, there will be a compromise here. You'll still have the exclusion, the ability to exclude a certain amount of income from the estate tax. The president wasn't saying it would all go away. I think they will try to shield businesses across generations, and I do think they'll do things, though, like cut back on the amount you can exclude, and they might do something about the step up away from businesses. We'll see.
Greg, your clients are sophisticated investors. What kinds of products are most in demand at Rockefeller?
Eric, one of the great things about our clients is a number of them have the ability to deal with more illiquid investments, and because of that, they can tap the private markets, where there's been enormous growth over recent decades. So we built a sizable investment platform that does due diligence on a range of alternative investments, as well as direct investments. We've brought some companies that are doing capital raising directly to our clients. And that's something that is an important part of what these elite financial advisors I've talked to you about tap into when they come to Rockefeller Capital Management. Given that our client base is primarily high net worth and ultra high net worth, we can do a fair amount of work in the alternatives, in the illiquid space, all the way through to directs. And that's the right thing for the profile of those clients. So we've been counseling clients given market volatility. I mean, Eric, who would have thought the market was going to fall, whatever it was, 35% last March? Even less likely in most people's minds to snap back. So public equity markets and public markets go up and down with the volatility hard to predict. So we want our clients to have a percentage of their assets in alternatives and direct investments that are more illiquid, but that smooth out those cycles and allow them to tap the phenomenal growth in private markets that has occurred over the last couple of decades.
Greg, our audience is very interested to know how much demand there is among your clients for cryptocurrencies, and what the House view is on the degree to which they are or are not appropriate for your clients.
Well, Eric, we've been cautious on this, and I think most advisors and advisory firms have been cautious on it, given the volatility in the space. And clients are clearly asking about it, some more than others. Our view on the whole crypto and digital currency space is that this is a change that is in the early stages, and you see that in the volatility around the price of the different ways of participating in this. It is probably something that is more secular in nature, though. Digital currencies are going to be part of the future.
They're coming.
We believe they're coming, and Eric, you and I have talked about this. Your kids and my kids, who are millennials and Generation Z, cash is effectively gone from those generations. There really isn't usage of cash in a lot of other countries, China, for example. So this is coming. Now, the question is, how will it look? I mean, if you look at electric cars 15 or 20 years ago, they were out there, but there's been a long relatively long ramp, to the point where now it looks like it's going to go through enough of a scale.
They're mainstream.
They're mainstream, and you're going to have a tipping point, and it's coming. We're not there yet here, and part of the reason we're not there is because governments and central banks have not weighed in and said, here's what we're going to recommend and do. Because they can create winners and losers really by fiat when they decide how this is going to unfold. But we believe that digital currencies utilizing blockchain technology is a game changer. It is going to be the engine of commerce in so many ways going forward. So utilizing blockchain technology, digital currency is coming, but governments and central banks are going to weigh in, and they're going to have a major impact on exactly how this unfolds and what those investments, those early investments, ultimately are worth.
Should I interpret that, Greg, to mean that Rockefeller will either not or be very, very careful about advising its clients to go into crypto absent some sign, rulemaking, whatever it may be from government on how they're going to deal with them?
I don't know that it's a line in the sand on government saying one way or another, but we are and will continue to be very cautious in how we advise our clients around digital and cryptocurrencies. The amount of volatility, the difficulty in assessing where the price should settle. When you look at the value of an asset or even a currency today in any country, even a country with more volatility on their currency, there are ways of going about assessing value, and that's very hard in this space. So we're being very cautious in what the dialogue we're having with clients around this, and urging them to be cautious.
Greg, another issue of great interest to our audience is the changing set of values from generation to generation as it concerns social good and the environment, all falls under the umbrella of ESG. To what degree do you see the younger members of the clients, the families that you advise, demanding more and more in the way of climate compliant or social equity compliant investments?
Eric, it's a great question, and it's secular. I mean, for millennials and for Generation Z, the focus on climate in particular, but the values embedded in ESG investing on a broader basis is significant, and we don't believe it's going to lessen or go away over time. This is, to use the word that is overused, but here I think it's relevant. This is a secular shift in investing, and in fact, I think at some point in the not distant future, you'll have almost an ESG overlay of all investing, where there will be a prism, an ESG prism that investing of any kind has to go through, because there's just so much appetite and receptivity around this. And you're seeing it, Eric, the Europeans are far ahead of the Americans in adopting on a broad basis ESG strategies and ESG investments. So we think it's a secular shift, and will be kind of table stakes in investing as we start to move forward here.
Greg, back in March, we witnessed a spectacular implosion of Archegos, a family office with a staggering $100 billion of investments. Rockefeller is not a family office. You advise families, but I'd like to know from you, understanding the nature of wealth as you do, and the structure of family offices and how they operate, should they be regulated?
Well, what happens when you have something like Archegos and what went on here, you have regulators step in and take a look at, is there a gap in the regulatory structure? And I'm sure they're doing that here. I think it depends upon the activities of family offices and actually what they're doing day to day, Eric. Our recommendation to, in particular, single family offices with material assets, but with assets that might be in the more hundreds of millions, it's a lot to take it on and do it internally. And we are providing counsel and advice to those family offices, because the reality is that at Rockefeller Capital Management, we've got a broker-dealer that's regulated. We've got an RIA. We've got an asset management business that's regulated. And it's expensive to take that kind of infrastructure and regulation on board internally. So, for family offices below a certain size, I think they're better outsourcing the types of things that regulators might otherwise say to them, well, if you're going to do this, we are going to regulate you. And that's the crux of the debate.
So it sounds to me as though this may be sort of what unfolds, that if the SEC or some other regulatory body demands more of family offices, both in the way of scrutiny and perhaps regulatory compliance, it may become too expensive a burden for some family offices, and they may have to then outsource to a firm like Rockefeller, some of their capabilities to a firm like Rockefeller.
100%. And I'm saying that not pitching for the business, although we're happy to work with many different family offices and counsel them. But the reality is that I think is what will unfold with the regulators taking a closer look as the result of what happened with Archegos, which they should. When something like that happens, they always step in, and they should.
Greg, we have just a couple of short minutes left, and I want to cover a little bit of ground as far as the business is concerned. As we've discussed, you've grown it tremendously in the space of 3 years in terms of scale, capability, the complexity of the problems you can solve, and of course, you've added Derek Jeter to your board. Some people may not know that. I'd like to know a little bit about where you've opened new offices, and more importantly, where do you plan to expand in the next few years? How important is it to be in the same communities as your clients?
We'll start with your last question first, Eric. Very important in our eyes. And we're expanding and focused on expanding primarily in the U.S. market at this time, although that wonderful Rockefeller name would allow us and would be a tailwind in Europe and in Asia, where it's still a very highly regarded name. But our strategy is a domestic strategy at this point in time. And we go to the cities and the locations where there are clients that fit the client profile that we're looking at, high net worth, ultra high net worth with sophisticated needs, and where we can find elite advisors that are serving those clients today. So Eric, we're in almost, approximately 20 cities today, and we could certainly add another 10 or 15 or even 20 more cities, over the next 3, 4, 5 years. It's not, we're not going to end up in hundreds of cities, but we want to be close to where both the elite advisors and the clients that they serve are. So we've opened in, we have a significant presence in Atlanta, but we're now in Florida and Boca Raton, and we're in Texas and Dallas and Austin and Houston, West Coast, not just San Francisco and LA, but Menlo Park. We've opened in Chicago. So, the United States is a big country, as you know, with a lot of wealth in places, throughout the country. Cincinnati, we recently opened and hired a wonderful first-class team there. So we'll continue to expand across the country under this iconic Rockefeller name.
If there are 2, 3 markets where you're not today, but you'd like to be, what would those be?
We're not in Colorado yet. We're not in Seattle yet. We're in Chicago and Cincinnati, but we could probably do more in the Midwest. We have a capability in Boston, but we're going to build that out more. So there's still, we're not in Nashville is a fast growth city. Charlotte, these cities in the South. So that's a good list of the types of places that we are likely to end up in.
Last question for you, Greg, and I want you to draw on all your experience as a banker, as an executive, as a thought leader for this one. Where do you expect the biggest surprises, positive or negative, in the next year or two?
I've been consistent on the positive side, Eric. I think there's a slingshot effect coming in the economy. And I think we can feel that in everything that we do, whether it's people who are so excited and happy to be out at a dinner where they can actually have dinner and not worry about contracting the virus with a mask off. So I think, there was significant uptick in savings over the last 12 months. So I think there's a slingshot coming in the U.S. economy where you could see rates of GDP growth in the second half of this year that we haven't seen in a very long time. On the concern side, there is a lot of liquidity that's been injected into the system, fiscal and monetary. And you have consumers in a good position in terms of their own balance sheets and ability to spend, with $1.9 trillion recently put into the system on top of whatever they had saved over the prior 10 or 12 months. So I have for years thought that inflation was being kept suppressed by the incredible pace of productivity through technology innovation and the constant pushing down of different prices because of the efficiencies wrought by technology. That tug of war is going to be an interesting one in 22 and 23 and beyond, given the amount of liquidity here. So I do think for the first time in a long time in the United States, there is a risk of inflation given the amount of fiscal and monetary and consumer stimulus that's going to be put into the system. And you're seeing some of this in commodity prices, lumber today. People talk about whether that's going to be a temporary thing, and you work through the next 3 or 6 months and prices reset. We'll see. And if I were the Fed, I would be watching this, and I'm sure they are, even though they keep saying different things publicly. I would be watching this very closely.